Okay, this video is for all those small business owners that are in partnership with one or more people. Now here's one thing to think about. How would it feel if you woke up tomorrow and found yourself in business with your partner's spouse, or even your partner's snot-nosed brat of a kid? Now, maybe you'd feel okay with that, but I'm gonna guess this might make you feel just a bit uneasy. Today's subject is buy-sell agreements and ways to fund partner buyouts to protect the value of your business and maybe more importantly, your sanity. But first, if after you've watched this, you found this helpful, please like and comment. This will help me get this stuff out to more small business owners. Also, make sure you're subscribed and notified. And if you're not a Swain CPA client, what the heck? Book a call. So, do you have a business partner? And if you do you have a shareholders agreement in place? Have you thought about what happens to your business if one of you dies? Do you have a plan to protect the value of your business? This is pretty serious stuff. If you or your business partner got hit by a bus tomorrow, or either of you became severely disabled, does everything go to shit for your family? And remember, we don't know when our time is up. Sometimes we have some lead time, but sometimes we don't. So I want you to stop and think. How good a plan do I have in place if I get called to the pearly gates early or disabled to the point where I can't work? Will my family think, wow, dad or mom really did take care of us? He really had his act together for us. So if you'd rather not carry on business with someone other than your business partner, there's several ways that a buy-sell arrangement at death can be structured. So one way is the surviving partner can purchase the deceased partner's shares with their own money or the bank's money. Another way is the corporation can redeem the deceased's shares. And there's more, but just for today, I'm going to illustrate the difference between these two ways. Now, there's a couple of common elements of every buy-sell agreement. There's a triggering event. In other words, someone has died or become disabled. There needs to be an agreed upon valuation method, like so that the deceased family or the disabled partner can get fair market value. And finally, the specifics for how the buy-sell arrangement will be structured and most importantly, financed. Because not everyone has a pile of emergency money set aside to pay out a partner at the drop of a dime. Having a good buy-sell arrangement in place that is well thought out, prepared, and funded gives you peace of mind that there's a smooth transition to the surviving shareholders. The deceased or disabled family is taken care of and their stress is reduced during a terribly tough time. The business will continue. Yes. So the big question is, what are the options to fund a buyout if we find ourselves in this situation? Some are better than others, which I'm about to show you. So first, you and your partners can agree to put corporate savings aside in a portfolio of investments. Yep, this is one way. I'm not loving this way because liquidating this investment can cause a bunch of corporate taxes. It can also cause some other severe tax issues that I'm not going to get into here. Another way is you can borrow money from a financial institution. Yep. How fun is that going to be? How expensive is that going to be? And what if the banks won't lend you money? Another way is that you can sell off the company assets to fund the purchase. Right, but is that going to possibly impair the business? I mean, don't we need those assets to operate? We could take funds from company earnings. Yeah, we could do that, but won't that also impair the business's cash flow and the ability to reinvest in people and equipment? Okay, here's my favorite option, insurance, either life or disability. Now, the easiest way for me to illustrate how cool insurance is for dealing with the buy-sell funding quandary is through an example. And I'm going to use one of the not so good options I just described, which is getting a bank loan and redeeming the deceased or disabled partner's interest in the company. And I'll contrast this with using insurance. So Luke and Leah are 50-50 shareholders in Vader's Children Clothes, Inc., which currently has a fair market value of $2 million. Unfortunately, Luke got killed in a freak sword fight accident. Luke has never married, and his nephew Ben, the beneficiary of Luke's estate, is antsy to get the money from the redemption of Luke's shares. He has some questionable intentions for the money, but that's another story. Leah frantically called her banker at Tantuine Finance and thankfully was able to secure a loan at 5% interest over 10 years and a payment of $10,500 per month. Ouch. Now, the interest on $1 million over 10 years is almost $270K, which is tax deductible. But here's the thing. Leah's going to have to generate more than $1.4 million in corporate earnings to cover off this $1 million payout. So once the bank forwards the loan monies to the company account, the company will redeem the shares, and Ben, who is really trying to get his first order business off the ground, might have to pay close to half of those monies in taxes, leaving him with only a little over $500K. And that won't even buy a TIE fighter. Okay, option two, and the one that I really like, is Luke and Leah very smartly took out a $1 million term life insurance policy in the company's name on the lives of each shareholder. The annual premium on the policy for two non-smoking 45-year-old partners would be about $1,300 per year for a 10-year term policy. Now, life insurance is not tax deductible, so it would actually take about $1,500 per year of corporate earnings to fund this policy. Now, what happens after Luke's untimely death? Here's what happens. The insurance proceeds are paid to the company exactly when Leah needs them, with no one other than the insurance company to call. The funds are paid totally tax-free to the company. See, life insurance is not taxable. And through some jigs and reels, I can get those funds out to Ben in a super tax-favorable way, provided this whole thing was set up properly. All at the low cost of 1.5 cents per dollar of monies required. And for Leah, well, she's now in control and ownership of the company. And it didn't cost her personally anything, not a ding-dang thing. I mean, hot damn. I mean, ain't this a no-brainer? Now, the two scenarios I just gave you are just but a few ways to fund the buyout of a departed shareholder. But there's very cool and creative ways to structure a funding arrangement depending on the specifics of your case. But here's the catch. The setup structure and the legal around doing these right are complex and require lawyers and accountants. Sorry, but things like these can't be that easy, right? Or everyone would do it, not just smart people like you. And I'm scraping the top of the iceberg here on ways insurance can be used to make sure that business can go on with some of the worst times in life happen. Because as hard as these things are during those times, life will go on. And people, family, employees, clients, and customers are relying on you and your partner. Now, who do you call to get the ball rolling for something like this? Well, it's not the Ghostbusters, it's me. I've got this special gift that not everyone involved in insurance has. I'm also a chartered accountant with extensive knowledge of the Tax Act and the mechanics of insurance. And I have very smart friends. So book a chat, email me, DM me, whatever. Get a hold of me and don't wait, because life events do not wait for hunky-dory time. As always, thanks for watching. Let me know you're out there with a like and a comment. And until next time, have an inspiring week, and may the force be with you.